Everyone wants to buy the breakout. Nobody wants to admit they bought the top. Because buying the top feels amazing for like 12 minutes. Then your chart turns into a ski slope and you start investing for the long term out of pure survival. And that's the problem. When you buy the top, you're often just providing exit liquidity for people who bought months ago and now want out. So today we're doing one thing. 5 topping signals that usually show up before US stocks dump. Not guarantees, not magic. Just 5 common clues traders use to tell when a trend is getting tired and the crowd is about to get humbled. By the end, you'll know how to read these signals without getting baited by fakeouts. Let's get into it. First, quick ground rule. Technical analysis is not fortune-telling. It's probability. It's crowd psychology drawn on a chart. Price moves because supply and demand are fighting. When demand is bigger, price goes up. When supply is bigger, price goes down. Everything we talk about today is just a way to measure who's winning and whether the winners are getting tired. And we're using one running example the whole time. Tesla's late 2021 top and the ugly 2022 drawdown that followed. Not because Tesla is special, because it was a perfect case study of hype, momentum, and then gravity. Okay. Signal 1. RSI Divergence. RSI stands for Relative Strength Index. It's a momentum gauge from 0 to 100. Think of it like a stamina bar in a video game. When RSI is high, the move has been strong and fast recently. When RSI is low, the move has been weak and fast to the downside recently. RSI does not mean overbought equals must crash. Overbought can stay overbought. Markets can stay irrational longer than you can stay liquid. So what's a bearish divergence? It's when price makes a higher high, but RSI makes a lower high. Price looks stronger. Momentum is actually weaker. In plain English, the car is still moving forward, but the engine is losing horsepower. The psychology. At tops, you often get a final wave of buyers. The headlines are perfect. The vibes are perfect. Everyone's friend's cousin is up 300%. But under the hood, the big buyers aren't pushing as hard. Demand is still there, but it's less aggressive. Meanwhile, supply quietly increases because earlier buyers are taking profit into strength. So price can still grind to a new high, but it takes more effort, and the move has less oomph. That's what RSI divergence is catching. It's like a phone battery that says 15%. You can still scroll TikTok, you can still take a selfie, but it's not a full day battery anymore. You're living on borrowed time. Not a sell signal by itself. A warning. If you see bearish RSI divergence, 1. Stop adding to longs like you're invincible. 2. Tighten risk. Raise stops. Take partial profits. 3. Look for confirmation from other signals, like volume, moving averages, or structure. Because divergence is the smoke, not always the fire. Next signal. MACD crossover. MACD is moving average convergence divergence. Yeah, the name is trash. The concept is simple. MACD compares 2 moving averages of price momentum and shows when short-term momentum starts losing to longer-term momentum. A bearish crossover is when the MACD line crosses below its signal line. The recent push upward is fading and downside momentum is starting to win. Think of momentum like a crowd pushing a shopping cart uphill. At first, everyone's hyped and shoving. The cart flies upward. Later, people get tired. A few stop pushing, then the cart slows. Then it starts rolling back down because gravity never unsubscribed. That crossover is basically the push is weakening. It often shows up after a big run when buyers are less urgent and sellers start to show up earlier. Tesla example. Around major tops, Tesla had periods where momentum started rolling over even before price did anything dramatic. That's the classic trap. Price still looks fine, but the internal push is fading. Traders who watch MACD are basically watching the push fade before the cliff shows up. Again, not a guarantee. Crossovers can whipsaw. You can get a bearish crossover, then price rips anyway. Markets love embarrassing people. When you see a bearish MACD crossover after an extended uptrend, 1. Treat it like a yellow light, not an automatic short it button. 2. Zoom out. If it's happening near prior resistance or after a blow-off run, it matters more. 3. Combine it with structure. If price also starts making lower highs, that's when it gets spicy. Okay. Signal 3. Moving average breakdown. A moving average is just an average price over a set number of days. Common ones are 20, 50, and 200 day. Here's the simple idea. Moving averages are crowd reference points. They're like the fair price people anchor to. In an uptrend, price often stays above key moving averages because demand keeps stepping in on dips. A breakdown is when price closes below a key moving average and can't reclaim it. In a clean uptrend, dips get bought. Why? Because buyers believe the trend is safe. But at a top, that belief starts cracking. The first time price drops to the moving average, buyers hesitate. Demand weakens. Sellers see it and press. If the moving average breaks and then price can't get back above it, that's a message. The dip buyers are no longer in control. Support becomes resistance. And that is a big deal, because it means the crowd's default buy zone is now a sell the bounce zone. After Tesla topped, one of the most painful parts was how bounces into moving averages started failing. At first, every dip felt like a buy the dip moment because that had worked for months. Then it didn't. And when it stopped working, it really stopped working. That's the shift from demand dominance to supply dominance. So, what? Watch 3 things. 1. Which moving average matters for your time frame? Swing traders often watch the 20 and 50. Longer-term people watch the 200. 2. The first clean close below after a long run. 3. The retest. If price bounces up to the moving average and gets rejected, that's often stronger than the initial break. Because the retest is where you see the role reversal in real time. Signal 4. Distribution volume. Volume is the amount of shares traded. Think of it as how many votes are being cast behind a move. Price tells you what happened. Volume hints at who's behind it. Distribution is when you see heavy volume on down days, or repeated high volume selling after rallies. It can also show up as a stock going sideways near the highs with big volume. That can be big players selling into eager buyers. Institutions can't just press sell all like you rage quit a game. If a fund wants to unload a massive position, they have to sell gradually, ideally without crashing the price immediately. So what do? They sell as retail buys the hype. That's distribution. Supply is being handed off to the most optimistic people in the room, and the chart often looks like price stops making progress, but volume stays elevated. Demand is still there, but it's being absorbed. Tesla example. Near major tops, Tesla had periods where volume behavior looked like churn. Lots of trading, lots of excitement, but price progress starts stalling. That's often where the handoff happens. Strong hands to weak hands. And once the handoff is done, there's nobody left to buy at those prices. Then gravity does its job. Look for 1. Multiple distribution days. That's a common term for a down day on higher than normal volume. 2. Sideways action near highs with elevated volume. That can be unloading. 3. Rallies that happen on weak volume, followed by sell-offs on strong volume. That's demand fading and supply hitting harder. Volume doesn't predict the future, but it's a great lie detector. Okay. 5th signal. This one is the most important. Lower highs, lower lows. This is market structure. The trend itself. An uptrend is higher highs and higher lows. A downtrend is lower highs and lower lows. A top is often the transition between the two. So the cleanest trend reversal signal is when price stops making higher highs, then breaks a prior higher low, then fails to reclaim it. That's the moment the market changes character. In an uptrend, buyers step in earlier and earlier. Every dip gets bought, sellers get punished. At a reversal, buyers start stepping in later. They hesitate. They want a better price. That hesitation is deadly, because while buyers hesitate, sellers don't. Sellers love hesitation. It's basically their favorite food group. So you get 1. A final high. 2. A pullback. 3. A lower high on the bounce. That's buyers failing to retake control. 4. A break to a lower low. That's sellers taking control. If you only learn one thing from this whole video, learn this. Indicators are helpers. Structure is the truth. If price is printing lower highs and then takes out a key higher low, the trend is changing. At that point, you either reduce risk, hedge, or you stop pretending you're a long-term investor just because the chart hurt your feelings. Okay, now we tie it together. How they combine. Single signals lie. They lie because markets are noisy. Fakeouts happen. News hits. Algorithms hunt stops. So the real edge is stacking signals. Here's a common topping bundle traders watch for in US stocks. 1. Price makes a new high, but RSI makes a lower high. Momentum divergence. 2. MACD rolls over and crosses bearish. Momentum shifting. 3. Price breaks a key moving average and fails the retest. Trend support breaks. 4. Distribution volume shows up. Heavy selling pressure behind the scenes. 5. Structure flips to lower highs and lower lows. Trend reversal confirmed. When multiple of these happen close together, the probability of a top goes up. Not 100%, but higher. And this is where most people mess up. They want the perfect top. They want to sell the exact tick high like they're in an edit on TikTok. Real trading is uglier. You're usually late by a little, and that's fine if you manage risk. Now let's talk fakeouts. Because yes, the market is a scam sometimes. Common fakeouts. Fakeout 1. RSI divergence that lasts forever. A strong stock can keep making new highs while RSI diverges repeatedly. That's not RSI is broken. That's just a powerful trend with minor momentum cycles. So you don't short just because RSI diverged once. You wait for confirmation. Fakeout 2. MACD whipsaw. In choppy markets, MACD crossovers can flip back and forth, like your friend changing his long-term plan every Tuesday. So MACD works better when a trend is extended and starting to slow. Fakeout 3. Moving average undercut and reclaim. Price can dip under a moving average, trigger panic, then rip back above it. That's called a bear trap. So you watch closes, retests, and context, not just one intraday poke. Fakeout 4. High volume that's actually accumulation. Sometimes high volume near highs is big buyers building positions, not selling them. How do you tell? If price is advancing and holding gains on high volume, that can be accumulation. If price is stalling and failing to advance despite high volume, that's more distribution-like. Fakeout 5. One lower low that instantly recovers. Structure breaks can fail. That's why many traders wait for a lower high after the break, or a failed reclaim of a key level before they say trend reversed. Okay, so how do you actually use this without becoming chart astrology guy? A simple workflow. Here's a clean process. Step 1. Identify the trend. Are we in higher highs and higher lows? If yes, assume the trend is up until proven otherwise. Step 2. Check momentum, RSI, and MACD. Are your is the engine weakening gauges. You're not predicting, you're monitoring. Step 3. Check key levels. Where are prior swing highs and lows? Where are the major moving averages? Because those are the zones where fear and greed concentrate. Step 4. Check volume behavior. Is selling getting louder? Are rallies getting quieter? That tells you whether supply is starting to overpower demand. Step 5. Make a decision that matches your time frame. Day traders care about different levels than long-term investors. Don't copy a signal from someone on a 5-minute chart if you're holding for 6 months. That's how you develop stress acne. Final takeaway. Your goal is not to call the top like a prophet. Your goal is to not hold a full-size position while the market is clearly transitioning from greed to fear. If topping signals are stacking, you scale out, tighten risk, or you step aside. Cash is a position, and it doesn't gap down overnight. If this helped, like and subscribe, and comment which stock you think is topping right now so we can all argue in the comments like civilized adults. Just promise me one thing. Don't become exit liquidity because you fell in love with a green line. See you next video.